So how do you know when the stock market is going to make a top or bottom? In this video, I'm going to walk you through an indicator that'll show you exactly that. Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. So if you're new here, consider subscribing. And today, we're talking about picking tops and bottoms in the market. So here is our indicator, and it is called the put-call ratio. And so on Thinkorswim, that is ticker symbol $P-call. And what this does is it takes all of the puts and all of the calls that are being bought in the market and compares them into a ratio. And so with this ratio, if it is at 1, that means that there is the one put being bought for every one call. Now, if the ratio is below 1, that means that there are more calls being bought than puts. And so generally, if there are more calls being bought than puts, that means more people are wanting the market to go up. And then if there's more puts being called, more people are thinking that the market's going to go down. And the idea behind this is that generally the market will do the opposite of what everyone wants. So if everyone thinks the market's going to go up, the market usually does the opposite and goes down. And if everyone thinks that the market is going to go down, the market is most likely going to go up. And so with this ratio, you're looking for extremes in the moving average. And so what I mean by that is here I have a 10-day simple moving average with this large teal line. And what I mean by an extremes is if this moving average gets over a ratio of 1 here, denoted by this green line, and that means that everyone is buying a lot of puts, and so they think the market's going to go down, which means that there is more likely a bottom coming in the market. And then on the flip side, if it gets below this red line, which is a reading of 0.75, that means that everyone is expecting that the market is going to keep going up, and so that more likely puts a top in the market. And you can see that quickly by this extreme reading right here. The market or the moving average was above that 1 ratio by a lot, and this means that everyone was extremely bearish, thinking that the market was going to go down. And if you go right down pretty much below that area, you can see that we put in a bottom in the market here and then took off from there. And then on the flip side, with this reading over here below that 0.75 area or below that red line, meaning everyone is thinking that the market is going to go up, well, that's kind of right where we put a top in the market and where this huge sell-off we had start from. And the reason why that if the average gets over 1, that's a bearish signal is because generally the market goes up, and so most of the time people are more inclined to be bullish and be buying calls or be buying stocks. And so when that ratio gets to just being 1 to 1, that means that most people are pretty bearish for the more short term, and they're looking that the market is going to go down. And so this is really a good tipping point to where you can expect for the market to actually put a bottom in. When this indicator is chopping between the two extremes in these areas, it really isn't worth using. You can kind of gauge some from it, but it really is a lot more important when it hits these extremes of outside 1. That is when you're really looking for those more extreme reversals or important turning points in the market to happen. Just because this indicator does make extremes doesn't mean that it's going to put in a major bottom for months to come, but it still does mean that everyone is extremely bullish or bearish, and means that definitely a more shorter term bottom or top could be in play. And so that's why you don't want to just blindly use this indicator by itself. You definitely want to be having other ideas in mind. This indicator just alone at least can help you with choosing the sizing that you're going to put on a trade. If the market, for example, looks really good right here and you want to go long on a position, this indicator, because you're showing from this indicator that the market is very bullish and really everyone is thinking that the market's going to go up, maybe you do a half size position or trade less than you normally would, because you know that, well, everyone's thinking this, so it's kind of more likely that it doesn't happen, but it still can. If we look at right at the before 2017 end and kind of like the beginning of 2018 when we had an initial super big sell-off in the market, you can see that here there were a ton of extreme readings in the market. The market was extremely bullish. And if you thought that, oh, right here, that the market is going to put in a top and it's going to sell off, and you started buying puts, you would have been buying puts right in this area. And as you can see, the market definitely did not go down from there. It went just about straight up. And especially when the first of the year came, it went straight up from there for sure. And so that's why you kind of want to use this sometimes with a grain of salt, but also really realize that it can be an extremely useful indicator when there are other things telling you that the market looks really good here or the market looks really bad here. In this area where you're getting this extremely bullish reading, but you're still seeing stocks go up, this is when you'd be wanting to take trades and still taking trades, but taking them at a smaller size with the idea that it's more likely that the trades don't succeed. And so if they do turn into losers, it's not as big of a deal. And then as we had that huge sell-off happen, the market went from everyone thinking that the market's going to go up to everyone thinking that the market was going to go down. And generally when that happens and everyone thinks that the market is going to go down, it's going to do the opposite again. And so that's when the bottom was put in the market and the market did start to move up from there. And so even here, when the market isn't necessarily making extremes, you can still use the movement of this moving average. For example, as we saw this bottom get placed in here, we can see that the market then began to move up from there. And then the put call ratio, or the sentiment of the market, people started to get more bullish again. They started to realize, oh, there's a bottom setting in. I don't want to miss this bottom. I need to buy it. And then right when it started to kind of get in midway, so people are kind of bearish or bullish and it's kind of neutral, that's when it put in a little mini top here. The market will go through shifts like this where maybe that you kind of have to adjust the line of what you think is an extreme reading. And so maybe for these couple months we had here, an extreme reading was actually in this area. And so whenever the market kind of got below this line, the market put in a top. And you can see right here, this is when a top was kind of put in as well. And so that's when the market started to then sell off again at these two levels we had here. Here was one, and then here was another. And those were both at kind of those maybe more of an extreme bullish reading that people were more excited thinking that, oh, it's over, the sell-off's over, the market's going to go up. But instead, the market did the opposite of what the majority thinks. And from there, the market decided to sell off and almost retest this low we had down here. And this is where we got another extreme reading. And I think this is a great indicator here. You get about the same level of bearishness as this area over here. But as you can see, the low is different. So this low right here is higher. And so essentially people are just as scared at these two levels, but this low over here is a little bit higher, meaning that we're putting in a higher low, but people are just as scared. So I think that's a really good indicator for a strong bottom again. And going forward, you can see that we did make in a longer term bottom at that level. Now, doesn't mean it was just straight up from there. It was still, of course, choppy in its way out of that, but it did then end up pretty much pushing all-time highs at that level. And then from there, we never really made another super bearish extreme until kind of where we are now in the market with another major sell-off. And so here again, we have another extreme reading where everyone is euphoric and thinking that the market's going to go up. And you can see that it doesn't necessarily put in a major top, but it does put in a top for the foreseeable near future. And if you're trading for, just a few days or weeks, that can still make a position a loser versus a winner. And so it is still very important to keep track of these kind of things and to be understanding the level of emotion in the market. This indicator pretty much just shows you the emotion of the market. And quite often when you do the opposite of what people's emotions are doing, you will be on the right side of the trade. Hey, so thanks for checking out this video. If you want more of these kind of market internal indicators, let me know and I will definitely be happy to make more videos on them. Now, if you have any questions on this particular video, make sure to ask them in the comments below. And if you just like this content in general, make sure to subscribe and I will definitely always have more videos coming out.